Imagine working long hours, multiple jobs, doing everything society tells you to do, yet still struggling to make ends meet. Imagine the weight of bills stacking up, the uncertainty of how to provide for your children, and the constant fear that one unexpected expense could send you into financial distress. Now imagine a benefit, a financial boost that could put money back in your pocket simply for the work you already do. That benefit exists, and hopefully you qualify for it. It's called the Earned Income Tax Credit, or EITC. The EITC is one of the most effective anti-poverty programs in America. It was designed for hardworking, low to moderate income individuals and families. Many people assume they don't qualify for the credit, so we're going to dive into that now. Let's talk about what the EITC does. If you're working, earning an income, and meet a few key qualifications, the government gives you a little extra to help pull you up just a bit. Even better, if you qualify for the EITC, you may also qualify for other tax credits, multiplying your financial benefit. So if you can claim the Earned Income Tax Credit, you aren't blocked from taking other tax credits. Now let's be honest, taxes can be confusing. It's like trying to decipher a secret code, but understanding the EITC can unlock real opportunities. First, there are some basic requirements. To qualify for the EITC, you must have a valid Social Security number by the due date of your return, including extensions. Be a U.S. citizen or a resident alien all year. Not file Form 2555 for an earned income. Meet certain requirements if you are separated from your spouse and not filing a joint tax return. Have earned income and have investment income below the limit. For 2024, your investment income cannot exceed $11,600. Please take a look at your screen for the maximum adjusted gross income that you can have and still qualify for the Earned Income Tax Credit. The Earned Income Tax Credit is not just for those with traditional 9-to-5 jobs. It's for gig workers, freelancers, small business owners, even clergy members, and those receiving certain disability benefits. It's for families, for single parents, and even for individuals without children. The key is understanding how your unique situation fits within the system. Imagine you're a single parent. You're not married, but you're working hard to provide for your qualifying child. If the child is not the qualifying child of someone else, and they live with you for more than half the year, and you paid more than half the cost of keeping up your home, you might qualify for the EITC. Maybe you're married, not filing a joint return, and living apart from your spouse for the last 6 months of the year. Or you're legally separated, and you have a qualifying child who lived with you for more than half of the tax year. Or perhaps your spouse passed away within the last 2 years, and you could have filed a joint return with your spouse for the tax year they passed away. And you didn't remarry by the end of the tax year, and you paid more than half of the cost of keeping up a home for the year, and you're raising a child or a stepchild who lived in your home all year. These situations can be incredibly challenging, but the EITC can offer a helping hand. And if you have a child with a permanent and total disability, they can qualify for the EITC regardless of their age. You will have to prove your child's disability by getting a letter from their doctor, healthcare provider, or any social service program or agency that can verify their disability. Now let's talk about something many families deal with: divorced or separated parents, or those living apart for the last 6 months of the year. There's a special regulation that allows the custodial parent, the one who has primary custody, to provide a written declaration granting the non-custodial parent the right to claim the child for the dependency exemption and the child tax credit. But there's a catch. Only the custodial parent can claim the Earned Income Tax Credit for that child. I do know some parents try to alternate years when claiming the EITC, but that's only possible if they alternate who has physical custody each year. Why? Because a qualifying child has to live with a taxpayer in the U.S. for more than half the year. If the IRS ever audits you and wants proof that you have physical custody, they'll send you a form asking for specific documents to verify that residency. So please keep that in mind. When most people hear about the Earned Income Tax Credit, they assume it's only for parents with kids. You can claim the EITC even if you don't have a qualifying child, as long as you meet a few key requirements. First, you need to meet the basic EITC qualifications that I mentioned earlier. That's the foundation. Then you need to have your main home in the United States for more than half the year. However, if you're living in Guam, the Virgin Islands, or Puerto Rico, unfortunately that doesn't count. Next, you can't be claimed as someone else's qualifying child on their tax return. After all, the EITC is for independent earners, not dependents. And lastly, there's an age requirement. You must be at least 25 years old, but under 65 at the end of the tax year. If you're filing jointly, at least one spouse must fit this age bracket. So whether you're working hard as a single filer or filing jointly with your spouse, don't assume the EITC isn't for you just because you don't have kids. If you meet the criteria, you could still get money back in your pocket. So of course you need to have earned income. But earned income isn't just a traditional paycheck. It's also the money you make running your own business or even serving as a minister. It's the income from your hard work in whatever form it takes. We're talking about the money you earn driving for rideshare apps, the income from selling your crafts online, the money you make running errands or providing creative services. If you're working, you're earning, and you might qualify. It's important to know what doesn't count too. Things like interest, dividends, unemployment benefits, Social Security, pensions, or annuities. Also, some disability benefits, such as Social Security disability insurance, supplemental security income, and military disability pensions don't count as earned income. Although these are important sources of income, they don't qualify for the EITC. If you're receiving disability retirement benefits, that's different. Before reaching your minimum retirement age, you should count it as earned income for the EITC. The IRS treats these benefits just like wages from a job, at least until you hit your retirement age. So how do you know your minimum retirement age? Check your retirement plan. It's the age you would have been able to retire if you weren't disabled. Once you reach that age, your disability retirement payments no longer count as earned income for EITC purposes. That's a big shift, so keep an eye on it. But here's something else you need to keep in mind. If you're receiving disability insurance payments, the guidelines are different. If you pay the premiums for that insurance policy yourself, those payments do not count as earned income when filing for the EITC. So whether you're receiving disability retirement benefits or disability insurance payments, knowing how they impact your taxes and potential earned income tax credit is crucial. If you're a member of the military, there are special guidelines if you receive non-taxable combat pay or were stationed outside the United States. Knowing how to navigate these guidelines can make a big difference in your refund. Here's the good news. You don't have to include non-taxable pay as earned income when you're filing your federal taxes. But wait, there's a catch. A good one though. If you're claiming the earned income tax credit, you can choose to include your non-taxable military pay as earned income. Why does that matter? Because it could increase your refund and reduce the taxes you owe. But there's a strategy to it. You have 4 different ways to handle non-taxable military pay for the EITC. Include all of your non-taxable pay while your spouse excludes theirs. Exclude all of your non-taxable pay while your spouse includes theirs. Both of you include all of your non-taxable pay, or neither of you include any non-taxable pay. The key to this? Run the numbers both ways. By testing out different scenarios, you can see which method gives you the biggest refund or reduces your tax bill the most. Don't leave money on the table. Make the choice that works best for you. I know that all of this was a lot of information. So if you don't know if you qualify to take the earned income tax credit, here's what you can do next. Check to see if you qualify. Don't assume you don't. You can use the IRS EIT assistant to check. I will include a link in the description box. I also mentioned the child tax credit in this video. If you want to know more about it, please watch the video in the upper left of the screen. Take care.